If you compare gold to treasury bonds, like just taking GLD, the most widely traded gold ETF, divided by TLT, the most widely traded bond ETF, that ratio, gold is the most expensive ever. China's becoming Japan. Everybody's turning Japanese. Certainly China is. If this whole big experiment, which I'm glad we're trying, doesn't work out, in 4 years, poof, it's gone. We'll never go back again. If it does work out, it's going to last for a long time.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffmann. I'm the JR mining guy over on X, and of course, your host of this channel. And I should be saying we're the Tariff channel today, it feels like, and not the channel where we discuss the macro to understand the micro. A lot of tariff talk today. We have to talk about it. So much going on in the markets. It's a day where we could put out 5, 6, 7 interviews just on this topic alone. And we found a phenomenal guest to join us today to talk impact on the commodity market. It's Mike McGlone. He's a senior commodity strategist over at Bloomberg. He's a friend of the channel. He's been on a couple of times. He doesn't need a long introduction today. So we can jump right into the topics here that we're going to discuss. Before I switch over to my guest, you guys know the spiel. 80% of you are not subscribed. Let's change that. Hit that subscribe button. Hit that like button and let us know, how do you think the tariffs are going to impact commodities? That's what we're going to discuss, with a big focus, of course, on gold and precious metals, and of course, Dr. Copper. We'll discuss why in a few short seconds here. And Mike, it's great to have you back on the program. It's good to see you. Busy day for you, eh?
Yes. Well, thank you, Kai. I was actually busier last night. It's kind of hard to sleep, but it's good to be back. And I always appreciate talking to you.
Yeah, likewise, and can't wait to see you again in person in May, actually, at the SME Current Trends in Mind Finance Conference. You were there last year. We got to catch up. I know you have a hard cutoff. A busy day for everybody here. Let's dive right in. The U.S. austerity, I think, is a big topic. Tariff war, declaration of economic wars, tariff outlashes, whatever newspaper you open. I think, what did Bloomberg call it today? Economic war declaration, I believe it was. But we need to talk impact on commodities. Let's start holistically, Mike. How is this going to trickle down, and how is this going to affect us?
It's worthy of the deflation that normally comes from the inflation that we had to the peak in 2022. We still haven't wiped out yet, and it's way overdue. Now we have a worthy catalyst for just reverting of the rapid advance of risk assets. So the thing that's working against our new Trump administration is they came into office with the U.S. stock market cap versus the rest of the world, the highest ever. We go back 50 years on that. Stock market cap to GDP, the highest in 100 years. Volatility at extremely low levels, but pre-existing trends in declining yields and declining energy prices. Now, those are stated goals of the Trump administration. I think they're going to get them. The key thing is right now, what's happening is a worthy catalyst for normal reversion. That's why, to me, I'm still very, very bearish most risk assets and the commodities, with the notable exception of gold. But the thing is, that's right now only within a normal cycle. What commodities always do, they get cheap after getting too expensive. So I'll go wherever you want. We can go wherever you want. So let's talk about start with the world's most significant commodity, WTI crude oil at $66 a barrel. Now that's near the low for the last 3 years, but for the last 20 years, every time it popped above 100, it didn't bottom till around 40. And now I think that's where it's going. It's just a question of time. So I'll end with this. I think by the time we get to the midterms, the average price of a gallon of gas in the U.S., which is around $3.20, is going to be closer to $2, which is going to be very good for Mr. Trump.
Yeah, it's interesting because I'm based in Germany, obviously, so our gas prices are already twice as high as the ones in the U.S. And I think I asked a guest, I think it might have been Bubba Horowitz the other day, it was like, how much lower can it go that it makes to have an impact, economic impact? Of course, free is always better than paying anything, but it almost feels unfair. Like, my point is, like, where's that breaking point for oil and gas prices that people are looking for here, because it's already cheap in comparison to other markets, for example.
So I do write, you mentioning Todd Bubba Horowitz. I do know Todd back from the trading pits, and I do appreciate you mentioned Peter. Well, you mentioned Peter Schiff before we went on. We used to be neighbors in Weston, Connecticut. So I guess that's a sign of my aging process. But the key thing about commodities, there's a simple fact of Adam Smith, and that is they always go to their costs of production. And it's the high price cure. That's a quote I learned in the trading pits. So Bloomberg New Energy Finance finance just dropped their average break-even cost of U.S. barrel of crude oil to $50 a barrel. Last year was $56 a barrel, and it's only going lower because of regulation and rapidly advancing technology and drilling techniques and things like that. And a lot of the pump and expensive things are going back down. Now, some things like steel and stuff might be a little expensive for a while, but that's their estimate. And you always have to get to that level to shut off what's happening. We have an increasing, growing global glut of crude oil, liquid fuels, natural gas, most notably from the US, and decreasing demand, most notably from China. And why is that? It came on the back of that big pump when Russia invaded Ukraine. Now, I was in the trading pits in 1990 when Saddam Hussein invaded Kuwait. That pumped crude oil from 20 or so to 40, and then went back down to 20, and it took a few years before it bottomed at 10. It's just happening now that the difference is the U.S. is now a massive net exporter, including with Canada. We export over 6 million barrels a day. To put that in context, in 2008, when crude oil peaked at 147, we were importing over 10 million barrels a day. The world shifted. Things like BYD offering an EV that can charge in 5 minutes and get 250 miles. It's just where technology is going. There's massive deflationary technological and product forces coming out of China. Some of us saw that in Japan. And crude oil is just at the epicenter of a normal bear market that hasn't reached a low price cure yet. This is a normal cycle. So it needs some kind of shock, some kind of surprise to get it to stay maybe above 75. And I think it's normally going to get down to 40. So what I do is I narrow down, that's the big picture macro. I've been, and your viewers and listeners probably know, I've been stating this for 2 years. Yes, maybe I'll eventually get it right, but it's the cycle that I expected. And now I think, so I've been narrowing more into what's happening in managed money net positions, i.e. futures positions, of people who actually make the trades, and their net longs are managed money. I think hedge funds are a bit too net long for the market to go up. They need to probably liquidate more to get a bottom like they did last year. For the first time ever, total petroleum managed money net positions got short for the first time ever, and that's when crude oil bottomed around 50, 65. Now we're at the same level, and they're net long. It means the risk is we still go lower, particularly if the U.S. stock market continues to mean revert. To me, that's the key thing to remember is last year, the U.S. stock market added $12 trillion of market cap. That's the most in history. That was 40% of GDP. That kept the Fed tightening. And right now, we're just taking this away. This is very much like 1999. And unfortunately, it could be like 1929.
No, like are these deflationary pressures that you mentioned, lower oil price, for example, is the biggest driver, of course, like priced into the market at all? Like looking at oil intensity industries, are they reflecting that or predicting that? Like the market is always one step ahead of the real price action usually, right?
That's a little harder for me to predict. I don't go to the equities as much. It's typically not, because what's priced in the market, what's on the screens almost always. And that's why I love when I'm always looking forward to what's not really priced in markets. And so to me, everything's you see in the screen, all the supply and demand projections that a lot of people do that are oftentimes backward looking, are already on the screen. That's at $66.83 at the moment. It's what's going to matter in the future that the market might not be expecting and that I'm anticipating, like my job is to be on top of. And that is the normal propensity to get cheap in commodities. It's happened in natural gas last year and it's bounced. But crude oil is the big daddy of them all. And I just love looking at the supply demand. Here's the most enduring trend I've seen in commodities for 20 years now. That is the increasing excess of production of U.S. crude oil and liquid fuels oversupply. It's been going up straight for 20 years. And the only time it's really dipped is when crude oil drops, because it's elasticity. Once crude oil prices go up, and which they have, it continues. So the key way to get that trend in excess supply to decrease is prices have to go down and shut off that spigot.
No. How do you throw the meta into that? And the meta, I mean the geopolitics here. That, of course, last 24 hours have been awfully muted because tariff talk took over the radio here. But how do you factor that in?
What's the stated goal of the Trump administration? Lower energy prices, which means natural gas, which is still about $4 per MMBTU, and lower inflation. And they have pre-existing trends in their favor. And according to my view, here I'll give you one example. The average price of gasoline in this country is around $3.20 a gallon. We mentioned, and I think it's going to $2. But and by the time they get to the midterms, that's going to be something they're going to say, hey, we got prices lower. But it's also what happens normally. And here's the key thing I think that market's underestimating is 55% of the people in this country are wage earners. The rich people who own a lot of property in stock markets didn't really vote for Mr. Trump. So if he gets the price of gasoline lower, the price of steel lower, the average mortgage rate much lower, so they can buy homes, which are the highest per relative to income ever, that's going to really help his constituents in the midterms and potentially by the time we get. But midterms are the next key thing for political to look for. But this is all going their way. And here's the number one way to get the Fed to ease and bond yields to go down is the stock market to go down. Because it's the reason they had to stop easing is because the stock market went up too much and created too much wealth.
Yeah, I think we're at 28% chance of a rate cut in about 34 days when the next Fed meeting sort of concludes. So that's an interesting barometer to watch here, of course, to see what the Fed will do. And the bond market touched, or the 10-year touched below 4 here before. You touched on inflation. We got to talk inflation because whatever he's been announcing yesterday has to be inflationary. Even if it's just a short-term blip on the screen, it will push prices likely higher. Doesn't really achieve his goals with that. Like, what's your perspective? What's your take on that?
So I do enjoy that tilt. And let's just make it clear, it's massively deflationary, because you look at the nuances of maybe, yeah, okay, it's a couple goods and services, just goods mostly, picks up the total trade balance in this country, imbalance is $1 trillion about. So let's say you add 20% on that, maybe that's through 200 to 300 billion dollars. Let's do the math. So far this year, the market capitalization of the stock market's dropped almost about $5 trillion. That's many X's of what the kind of inflation you might get from good. That's the most significant deflationary forces. The deflating U.S. stock market. I'm saying, and from a market cap to GDP basis, it's the highest in 100 years. And it's just reverting now. So if we give back, we've already given back about half of last year's $12 trillion. That's deflation just getting started. So it might not show up in the numbers right away, but it's showing up in the bond market, and they get it. 4.04 in that U.S. Treasury note, which, by the way, is still over 230 basis points above what we see in China, 1.72. And I just have to remind people, I traded Japanese government bonds in 1995, and I've seen this before. Deflation on a global basis is accelerating. China is really pressuring it lower. And once that U.S. stock market goes down, it's kind of 1930s type deflation, just getting started. But it's normal. The book Price of Time by Edward Chancellor just pointed out, we always get deflation after inflation, most notably when we pump liquidity. And also, I just love that book by Jeff Booth, The Price of Tomorrow, pointing out the deflationary forces of rapidly advancing technology. Just look at all this rapid technology that's being exported out of China, and the U.S. has to put imports tariffs on it to prevent, the collapsing our U.S. the automakers, because they make better cars and are much cheaper.
Yeah, absolutely. 5-minute charge time for a BYD vehicle now. That's we got to protect ourselves from it. We don't have that yet in the West. So
not yet, but that's that deflationary force.
It's coming.
Yeah.
Mike, remind me to ask you about Japan after talking commodities here, but see how we can fit in Japan and 1980s Japan and compare that to the U.S. We'll save that goodie for the end, but let's move over to Dr. Copper. And quite honestly, personally, despite copper moved up quite a bit, $5.20. It's come down, of course. We're at $4.84 a pound today. Massive recession indicator. I was surprised to see copper actually break through $5, $5.20. A, what prompted that move much higher? Was that Chinese stockpiling? And B, what is Dr. Copper telling you right now on a global basis?
So one thing about copper, I'll just state my facts. I think it's minimum going down to 4. That's essentially almost where it's trading in London now, and if you convert to a U.S. dollar price. But part of the reason, the number one reason copper is going to go down is because it went up. It's just the way copper works. Last year's high was $5.20. That was really driven by U.S. futures. Got way too extended long, and the low came around 4. It's doing the same thing now, and that is, as an ex-trader, I look at copper as our viewers have probably and listeners have heard this from me before. I know I probably would have been stopped out trying to short it, but once it made that high a couple of weeks ago, about 537, that to me was a red light leaning. We just squeeze as many shorts as possible. We're going to do what it normally does and go back down. The key fact for copper is it was just the major disparity in spread on anticipation of U.S. tariffs on imported copper. It made that spread between U.S. traded copper and London copper reach almost 20%, the greatest ever, and futures going back to 1997. So that put in a good, blow off top. Now the risk is it goes back to 4 and maybe even lower. Because what is bullish about Dr. Copper, the metal that known to have a PhD in economics, from the rest of the world facing tariffs from the world's most powerful, significant demand pull source that's been waiting to do these kind of things for decades. I mean, so to me, this is that was decent blow off top. But the key thing I learned in commodities trading is you got to hurt the most people first before you go in the direction it really belongs. So I think copper minimum is going to go down to 4. I think it's good resistance around 5, and then we'll see if it gets really serious. It's got to stay above 5 to show something really bullish, which I think is unlikely. I think the risks are, like crude oil dipping to $40 a barrel, the risks are that copper goes back below $4 a pound. Now this is looking ahead. The key thing about copper though is if U.S. stock market goes down, that's a huge headwind for copper.
No, absolutely. Just demand will disappear and income and yeah. I brought up China real quick. Any thoughts? Like I read rumors China stockpiling critical minerals, copper one of them. Is that has that been a factor in the price? The
number one thing that they're stockpiling is gold. So that's part of the reason we had this massive gold rally the last few years. China's central bank, Chinese citizens, they might be curtailing some of their buying. As far as stockpiling, everything else, yeah, they usually, China's very good traders. They buy low, sell high. So stockpiling, when it's at the highest level, and copper didn't make a lot of sense to me, but people always have to use their narratives. And when it gets lower, that's what they typically do. They're just good at that. That's one thing you learn in trading commodities. But either way, the bottom line is China's economy is doing almost, to me, exactly what I saw Japan did when it peaked in 1989. Now, I worked for Japanese firms, and I remember running around that Imperial Palace in Tokyo in the 90s when it was worth more than the state of California. We just saw the same thing happening in China. Property values reached almost 5x what they did in Japan, but versus GDP, way too expensive, going back down. And then they decided to piss off their best customers by, according to NATO, being a decisive enabler of a war in their backyard. It's just silly. The things that are happening. I think it was Zanny Binton Meadows of The Economist who pointed out that President Xi is an economic incompetent. This is not my quote, it's hers. But to me, that's what's happening in China. There is no natural check and balance in that country. Mr. Xi is, by some measures, as I heard of people say, more autocratic than Mao was. And he's going back to the old days of autocratic communist leadership. Like, good luck with that. Yeah, you're not going to have any natural check and balance. And sure, you're going to crush a few things, create a lot of massive deflation in renewables and EVs and things. But overall, the place you've been able to export to, most notably U.S., and to gain a lot of wealth from the last 2 decades is done. They're done doing that and transferring the wealth to your country, according to Robert Lighthizer's book, No Trade is Free. So, and who are they going to export to? I did enjoy the recent inklings of China and Japan and South Korea trying to hook up together. And our chief economist, Anna Wong, said, yeah, great. Who are they going to export to? They're all predatory exporters. It's just silly. I mean, but it's all the lessons of Adam Smith. You want to get wealthy, protect your markets and export. And the U.S. is just putting a kibosh on that. And this resonates from someone like me. I mean, I started in trading pits in Chicago. I have to mention Chicago, the heart of the Rust Belt. And a quote I learned in the pits was, in the 90s during NAFTA and everything was, everybody in the world wants free trade as long as they can run net exports with the U.S. That has been kiboshed.
Yeah. No, interesting commentary there, Mike. And before we get over to gold, I want to... Peter Schiff posted something on X today that actually fits our discussion. I'd like to share that with you. Let me get that on the screen here. I hope you can see it, Mike. Let me add that to the stage. Here it is. Commodities like oil, silver, and copper are down sharply today as investors are pricing in a global recession, but the recession will mainly be limited to the U.S. That's what he's saying. The rest of the world is about to boom. Because they've been subsidizing the U.S., they don't have to do that anymore. Where's the point? And U.S. has a difficult road ahead. We need to start producing all this stuff we've been importing. That requires significant investment, short-term, and the U.S., the rest of the world has to consume more. So my point is the rest of the world actually going to see deflationary pressures because the supply is there, but the demand hasn't been. So we have an oversupply in the rest of the world that used to be exported to the U.S. So I want to throw that question in there, especially in regard to the commodities.
I think he's missing one key thing. The rest of the world has become increasingly dependent on net exporting to the U.S. for decades. And what President Trump did, and Robert Lighthizer pointed out he would do, is trying to offset that. The key thing I always like to point out is when you have the world's largest demand pull economy, say U.S. versus Canada, it's impossible for Canada not to run a surplus sending more goods to U.S. So even that out is to U.S. have an average 10% tariff. That evens it out. I mean, if I go to the Ritz, I have to pay to park. If I go to Hotel 6, I don't have to pay. Just that's life. The thing is, now we're learning this. I mean, remember, I'm from the Rust Belt. I don't have any sympathy for all the people people. I saw the D's, the deaths and the divorces from people losing jobs. It's not just that, but the markets. The point is, this is we are looking forward. So one thing Peter Schiff, I think, is missing. I'm still bullish gold. The key thing I want to mention is I was on a crypto chat the other day, and I was pointing out how bullish I'm gold and how bearish I'm cryptos. And the quote is, they said, "Oh, you sound like Peter Schiff." I took that as a compliment because he's a perpetual gold bull. He really missed out on Bitcoin. He admits that. But now everything's going his way, at least for gold. The key thing he's missing, though, is there is virtually no demand pull forces out of China. China's in a deflationary spiral, just like Japan was in the 90s. It's some combination of when the Soviet Union and Japan peaked in almost 30 years ago is what's happening in China. Who are they going to export to? Germany is an export predator. Basically, they 50% of their GDP is exports. They're not going to export to Europe's going down. Europe has to export to US for wealth. This is a global recession kicking in, and the U.S. is generally going to come out the best. The key thing is U.S. stock market so expensive. That is where the deflation is really going to come from. The U.S. stock market just reverting, dropping at least a third. I mean, S&P 500 going from 6,000 back down to 4. It's not a big deal historically. It's where it was a few years ago. But the rest of the world is just, this is a shock, and it's the paradigm shift in the world order, and you can see that in the, like I said, I saw that in Japanese government bonds in the 90s, right near that 10-year note yield in China at 1.72. You can't hide the math, but that's a sign of where things are going as far as deflation. Once we see maybe some demand pull forces, maybe some pickup in inflation in China, good luck. But remember, here's a key thing I'll end with. China is increasingly dependent on increasing fiscal and monetary stimulus just for stability. OPEC has been, and the crude oil market was dependent on OPEC supply cuts just for stability. Those things are going, it's just, we've reached the limits.
Yeah, no, absolutely. And, China pumping money into the economy to boost the service sector. That, I think, tells you everything you need to know, that there's a bit of shaky ground in China or in Asia. I don't want to, careful with the earthquake here, but in terms of shaky ground. Mike, we got to talk gold. This is the gold chart from today. What an impressive move. The dip was bought 3060. Beautiful V-shaped recovery in the gold price chart. Let's talk about gold. Is that the only asset class that can sort of escape the gravitational pull of the main markets?
U.S. Treasury long bonds. So I think gold is cheap versus the U.S. stock market historically, and just starting to break out. I love to look at that gold divided by S&P 500 ratio. It got well below 0.4 or so, and now it's jumping up to 0.6. It's probably going to go to 1-to-1. It's what it always does. That's ounces of gold divided by S&P 500. But if you compare gold to Treasury bonds, like just taking GLD, the most widely traded gold ETF, divided by TLT, the most widely traded bond ETF, that ratio, gold is the most expensive ever. Now, that's only 20 years. We have other data that goes back 50 years. So I think what's happening is going to happen is I'm still very bullish gold. I think eventually it gets to 4,000, and maybe it meets the S&P 500 at 1-to-1, S&P 500, 4,000, gold 4,000. Maybe eventually gets there. But we're at the point now where it's stretched above $3,000 an ounce. It needs continued deflationary forces, which is happening from the stock market. Just a little bit hard today. We're hitting some stops like we did in 2008. The key thing is it's so expensive versus bonds. So I think what it's doing is gold is passing some of that deflationary rally, risk-off appreciation to the U.S. Treasury bond market. And to me, because I've been saying this for almost 2 years, that's probably the next big trade. U.S. Treasury long bonds at 4%, just catching up to where they are in China, below 2%.
No, if I would have asked you, if I would have interviewed you 3 hours ago, my question would have been, why are the bond yields dropping while gold is also crashing? But that trend has reversed. Yeah. And the explanation of the move today, why was the dip bought as aggressively?
Sell what you got and not what you want. I remember I used to be in the trading pits, and I remember being on the other end of those phones. The quote we used to use is GMTFO, get me the heck out. And I have clients say things not so nice to me sometimes, like, yes, we just execute, and you're always hitting bids when they're saying that. That's what's happening. So gold has been stretched from managed money net positions for quite a while. A lot of those things have been lightened up and going in ETFs. So this is just a little liquidation. I think gold is first supports around 3,000. I don't think it stays much below that. The paradigm shift that's happening in the market of just a little bit more deflation finally accelerating in the U.S. stock market, and people finally getting it, is good for gold. But this is a little bit of long liquidation. I mean, gold's been one of the best performing major assets this year. It was outperformed by copper, but we know what's happening to copper. It's going down. So just some liquidation liquidation. I think it'll stabilize and eventually head to 4,000. The key thing is if the U.S. stock market's drop into S&P 500 towards 4,000, which I think that's good for gold to head towards 4,000. But again, that's very much significantly deflationary. And on the year right now, that U.S. Treasury long bond, like TLT, is up about 7%. Yeah, 6 to 7%. Bitcoin's down 12%. S&P 500 is down 7%. That's deflation just getting started. The point is it's so overdue. So still bullish gold. Pretty good support around $3,000. It might tick below that a little bit, but I think and I'm pretty sure these trends that we really accelerated today are going to continue. And that's just deflating risk assets. Means from here on, a long duration like a 30-year zero coupon bond might outperform gold.
Yeah, we had a few guests on that says like, well, deflationary shocks. And when I look at the gold price chart today, yes, it's only today. It's only a few hours of trading. Yeah. But is that something we could expect if that really happens? It seems like it was a short-term blip on the radar screen, but I keep getting reminded of like August of 2024 where we saw that. I think it was August 5th or so. I wouldn't call it a flash crash or so, but there was a rush for liquidity or to liquidity in that regard. Is that something we saw today as well this morning, and especially in the main markets?
It's just margin calls. You got to sell what you can, and gold's, if anybody's been long, gold's got a lot of profits there they can sell. They've already started selling Bitcoin. There was a lot of profits there. Started selling that well before, but I think that's a key thing to remember. I want to rope that in there because to me, what's happening in gold is what's most significant to mention, and we've had almost about 4 years of significant outflows in gold ETFs. That's flipped now. They've just shot up this year, completely tilted around. Investors are getting it like, yeah, I need some store value. I'm done. The S&P 500 was on a tear, yields were higher, volatility was low. That was always a pressure factor in gold. That's switching. So investors are flipping towards gold. They're getting it. We've already seen the central bank buying, so I'm still quite bullish gold. I think this is just a blip in the trend. But what happens sometimes is you need one day to flip the narrative, and I think everybody gets it now. Risk assets, most notably risk assets, are for sale on rallies. Yes, that means they're going to be sharp short covering rallies. But gold, I think, is going to be bid on bought on dips, maybe around 3,000. The key thing that really triggered me is when Bitcoin hit $100,000 on that massive frenzy. That was a signal to buy gold, sell Bitcoin. And it's very similar to me in risk assets. It was very similar to me that when the NASDAQ printed 5,000, NASDAQ Composite in 2000, right about 25 years ago. And the key thing I like to point out is gold is great. It's zero correlated. In fact, it's negative correlation in stock markets increasing, increasing, the negative correlation increasing. Yet the correlation of Bitcoin, sometimes people call it digital gold, the stock market's increasing. We're finding out that digital gold is actually much more of a leveraged beta. It's going down at a higher volatility in the stock market. And the difference is gold has three dependents: silver, platinum, and palladium. The only reason they're really going up is because gold's going up. People need to know that silver is not going to outperform gold in an environment like this, with stock market going down. It's unlikely. But Bitcoin was the first crypto in 2009. It had a great run. Everybody loves it. Now it has millions and millions, 13 million dependents based on what the data last on CoinMarketCap.com. That's a problem. And you look at the next most significant, Ethereum, looks like it's breaking down below 2,000. I just see that as we increase volatility in the stock market, as we take the stock market out, we're finding the cryptos, most of these, which are still silly expensive, are going to maybe lose a couple zeros of value, like stock market, like a lot of dot-coms did, and gold should continue to appreciate.
Yeah. No, I fully agree. It's like I'm a gold bug. It was a little overbought. And you brought up the Fedcoin and the Bitcoin reserve and all that. And when I heard Joe Rogan, Elon Musk, and Donald Trump talk about auditing Fort Knox and actually bringing gold back into the mainstream media and into the headlines, I was a little nervous. And
yeah.
But then gold kept rallying, so I was like, okay, I was obviously wrong. So, but it was an interesting, it's just gut check as well. Really interesting conversation, Mike. I wrote it down. We got to talk Japan just for a minute here before I let you go, because you're a Japan expert. And I'm wondering if April 2nd, 2025 was the day that the U.S. started to look like Japan does now, meaning 250% GDP, a currency that is still valued in the world, but not a world reserve currency anymore. Is this the beginning of the end, or is this the U.S. becoming Japan? Is that...
Well, it's China's becoming Japan. Everybody's turning Japanese. Certainly China is. But as far as that, I think it's silly. And the gold bugs like to say it, and nothing against. I think it's silly to say that. The difference is Japan's an island. and it exists because the U.S. decided not to wipe it off the map, and just think of the facts. And it's become wealthy because it's exported to the U.S. What you see the facts here? Who provides the security? And can China and Japan export to each other? No, good luck. Well, Japan's got a big problem with BYDs and all the EVs coming out of China. So I look at Japan as just been a great example. Like I said, I traded JGBs in the 90s. I saw what happened. And that's what's happening in China. And I think that's the key thing to remember here is there's a natural check and balance in the US. And you'll see that if this whole big experiment, which I'm glad we're trying, doesn't work out in 4 years, poof, it's gone. We'll never go back it again. If it does work out, it's going to last for a long time. In the midterms, we'll see. But by the time we get to the midterms, I think the things that'll help Trump get, help his party get, gain, maintain some power, low inflation, very low interest rates in the U.S., low mortgage rates, very low price of gas. Hopefully the stock market would have been corrected too much. Those are good. The key thing to remember about Japan is, remember, it's a lesson I learned, I think an economist wrote about it years ago, that if you, in the last century, if you want to become wealthy, you cozy up to the U.S. Now, Japan did that. China's doing the opposite, and they're learning the hard way. It's just a fact of history. It's not bravado or anything, just the fact of also, it's that natural check and balance in this country that is working. Like we all know, that was entertaining when we heard recently Trump said, yeah, I might run for a third term. Like, good luck, dude, because that doesn't usually work in the check and balance in this country. Go ahead, test it. Now, he'll test extremes. We got to remember that. But come 4 years from now, this is going to be an entirely different mantra and country. And we'll see how that works out. But that's the natural check. Don't have that in China right now. And China is potentially worse than Japan was when they peaked in 1989, 90.
No, fantastic insights, Mike. Really, really appreciate you taking the time yet again. I always appreciate you coming on. Where can I send our audience? You got your Twitter handle obviously on here. Should we just send them there?
Well, I love your show. So on your show, obviously the Bloomberg Terminal, and LinkedIn, just Mike McGlone, Senior Commodity Strategist. I'm always happy to add people to my distribution list if they want to reach out. And thanks for having me on your program, Kai. I really enjoy it.
Absolutely. Yeah, I love your daily articles. So really, although sometimes I have to throw them in ChatGPT to decode them a little bit. So
got it.
Appreciate it. Mike, thank you so much for your time. Thanks so much for coming on. Everybody else, thank you so much for tuning in. I hope you enjoyed this conversation with Mike McGlone, Senior Commodity Strategist over at Bloomberg. And if you did, please leave a comment down below, leave a like, and of course, subscribe to the channel. Helps us out tremendously, and it's a free way to support us. Thank you so much for tuning in. We'll be back with lots more. Thank you. Take care.